Most people think crashes announce themselves. They imagine a loud siren, breaking news, red screens, and a clear moment where everyone suddenly agrees that danger has arrived. The uncomfortable truth is that by the time a crash feels obvious, the real positioning has already happened quietly, months or even years earlier. Markets don't reward the people who react fast. They reward the people who were already standing in the right place before anyone felt the ground start to shake. That's why this conversation matters now, not when headlines turn dramatic. Crashes aren't just about prices falling, they are about liquidity drying up, confidence shifting, and incentives changing faster than emotions can keep up. Most investors don't actually lose money because they chose bad assets. They lose money because they chose good assets at the wrong time, with the wrong expectations, and without understanding what those assets are supposed to do when stress enters the system. Before we go any further, it's important to be clear about one thing. This is not a prediction. This is not a warning bell. And this is definitely not about panic. This is about preparation. Experienced investors don't try to guess the exact date of a downturn. They accept that cycles exist, that human behavior repeats, and that uncertainty is permanent. Instead of fighting that reality, they build around it. The biggest misunderstanding about crashes is the idea that safety and growth live in completely separate worlds. People tend to think you either protect yourself or you make money, as if those goals cancel each other out. In reality, the most resilient portfolios are built by understanding trade-offs, not by chasing perfection. Risk doesn't disappear. It simply changes form depending on where you choose to stand. Another common mistake is assuming that what worked during expansion will automatically protect you during contraction. The habits that feel smart when markets are rising can quietly become liabilities when conditions reverse. Leverage feels efficient until volatility increases. Popular assets feel comforting until everyone tries to exit at the same time. Speed feels powerful until patience becomes the rarest resource in the room. So when experienced investors think about downturns, they don't ask, "What will go up?" They ask, "What still works when things stop working the way I expect?" They think in terms of survival first, optionality second, and growth last. Not because they lack ambition, but because staying in the game matters more than winning a single round. When you strip away the noise, the debates, and the personality-driven opinions, a clear pattern emerges. Before major downturns, capital tends to concentrate into a very small number of places. Not because those places are exciting, but because they perform specific roles when uncertainty rises. These are not assets that promise overnight transformation. They are assets that quietly do their job when everything else is struggling to do its own. If I had to reduce that entire philosophy into just two assets, not as guarantees but as strategic anchors, these would be the two I'd bet everything on before a crash. Not because they are flawless, but because they align with how human behavior, incentives, and systems actually function under stress. The first asset is not new, not trendy, and not particularly impressive on the surface. It doesn't come with bold marketing or dramatic stories. In fact, it's often criticized during bull markets for being boring or unproductive. But when conditions tighten, this asset reveals why it has survived every financial era in one form or another. That asset is high-quality government-backed bonds with reasonable maturity, held with realistic expectations. This might sound underwhelming, especially if you've been conditioned to think bonds are outdated or irrelevant. But experienced investors don't dismiss tools just because they lack excitement. They evaluate what a tool is designed to do. Bonds, when chosen carefully, are not about chasing returns. They are about stability, predictability, and income when growth assets become unreliable. The key word here is quality. Not all bonds serve this purpose. Low-quality debt, speculative yields, and complex structures often fail precisely when protection is needed most. But high-quality government-backed bonds operate under a different set of incentives. Their role in the system is tied to trust, stability, and monetary policy. When risk appetite declines, capital often flows toward what is perceived as reliable, even if the return is modest. Another misunderstood aspect of bonds is how they behave when fear enters the market. In many downturns, interest rates fall as policymakers attempt to stabilize conditions. When rates fall, existing bonds with higher yields become more valuable. That price movement can offset losses elsewhere, creating balance rather than excitement. This is not about winning big, it's about losing less and staying liquid. Liquidity matters more during downturns than most people realize. The ability to rebalance, to cover expenses without selling growth assets at poor prices, or to take advantage of opportunities requires assets that can be converted into cash efficiently. High-quality bonds often serve that role better than assets tied to sentiment or leverage. There's also a psychological advantage here that rarely gets discussed. When part of your portfolio is doing its job quietly, it reduces the emotional pressure to make impulsive decisions. People don't sell at the worst possible moment because they lack intelligence. They sell because anxiety overwhelms logic. Stability creates space for patience, and patience is one of the most valuable currencies during a downturn. Now, this doesn't mean bonds are immune to risk. Inflation can erode purchasing power, poor timing can reduce returns, policy changes can shift expectations. But experienced investors understand that risk is relative. The question is not whether an asset has risk, but how that risk behaves compared to everything else around it. The second asset I'd bet everything on before a crash is often misunderstood in a completely different way. Unlike bonds, it's frequently viewed as speculative or emotional. Some see it as outdated, others see it as a miracle solution. Both views miss the point. That asset is productive real assets with intrinsic utility, especially those tied to essential needs. This doesn't mean luxury properties, over-leveraged developments, or assets dependent on constant appreciation. It means assets that people need regardless of economic conditions. Housing in stable areas, infrastructure-linked assets, farmland, energy-related assets, things that serve a purpose beyond price movement. The reason these assets matter before a downturn is simple. Demand for essentials doesn't disappear when markets fall. It changes shape, but it doesn't vanish. People still need shelter, goods still need to move, energy is still consumed, food still needs to be produced. Assets connected to these functions tend to experience less extreme swings than those dependent on optimism and discretionary spending. Another important feature of productive real assets is their relationship with inflation and currency shifts. When confidence in financial systems weakens, tangible assets often retain perceived value because they exist outside pure financial abstraction. They are not numbers on a screen, they are physical, functional, and limited. Experienced investors don't buy these assets to flip them, they buy them to hold, operate, and collect income. Cash flow becomes more important than appreciation during uncertain periods. An asset that pays you to wait reduces pressure and increases resilience. There is also a time component that works quietly in favor of real assets. They reward patience. Maintenance, management, and gradual improvement compound over time in ways that short-term speculation cannot replicate. This kind of compounding isn't exciting, but it's durable. Of course, real assets come with challenges. They require capital. They require oversight. They are not instantly liquid, but that illiquidity is part of what protects them. When everyone is rushing for the exit, assets that cannot be sold with a click are less exposed to panic-driven pricing. What ties these two assets together is not their surface characteristics, but their function during stress. One provides liquidity, stability, and psychological relief. The other provides utility, income, and insulation from purely financial volatility. Together, they form a foundation that allows experienced investors to endure downturns without being forced into poor decisions. It's important to notice what's missing from this list. There is no promise of rapid transformation, no claim of immunity, no suggestion that risk disappears. Instead, there is an acceptance that downturns are part of the system, and that preparation beats prediction every time. Another reason these assets are often overlooked is because they don't perform well in storytelling-driven environments. Social media favors extremes, either explosive growth or dramatic collapse. Quiet resilience doesn't go viral, but wealth is not built by entertainment, it's built by consistency. There's also a behavioral element at play. During long periods of growth, people become conditioned to expect constant improvement. Assets that lag during those times feel like mistakes, but experienced investors understand cycles. They are willing to look wrong temporarily in order to be positioned correctly later. This mindset shift is critical. Instead of asking, "What will outperform next year?" they ask, "What will still be standing when conditions change?" That single question filters out most of the noise. It's also worth addressing the idea of betting everything. This is not about concentration in a reckless sense, it's about conviction in principles, not blind confidence in outcomes. Experienced investors diversify within frameworks. They don't scatter randomly. They choose assets that serve different roles and accept that no single asset does everything well. Risk versus safety is not a binary choice. It's a spectrum shaped by time horizon, cash flow needs, emotional tolerance, and opportunity cost. Younger investors may accept more volatility. Older investors may prioritize stability. The principles remain the same, even if the balance shifts. Another often ignored factor is behavior during recovery. The assets that help you survive a crash also position you to participate in the rebound. Liquidity allows you to act. Stable income allows you to wait. Ownership of essential assets keeps you connected to real economic activity rather than abstract momentum. This is where many people miss the second-order effects. Selling everything during a downturn may feel safe, but it creates reinvestment risk. Sitting in cash too long erodes purchasing power and opportunity. Assets that maintain function during stress help bridge that gap. None of this requires extreme wealth or insider access. These principles scale. The form may change, but the logic doesn't. Whether someone is managing a large portfolio or just starting out, understanding why assets behave the way they do is more valuable than memorizing ticker symbols. It's also important to separate preparation from fear. Preparing for a downturn doesn't mean expecting disaster. It means respecting uncertainty. It means acknowledging that the future will not unfold exactly as planned and building flexibility into your decisions. Flexibility is one of the most underrated advantages in investing. The ability to adapt without panic, to adjust without desperation, and to think clearly when others are overwhelmed is not accidental. It is built long before stress arrives. When people ask why experienced investors seem calm during volatility, it's not because they are emotionless. It's because their portfolios are aligned with their expectations. They don't expect everything to go right. They expect variability and design around it. This approach also reduces the temptation to chase trends late or abandon discipline early. When your core is stable, you can afford to be selective rather than reactive. As we move through periods of uncertainty, it's worth remembering that markets are reflections of human behavior. Fear, optimism, greed, and caution cycle just like prices do. Assets that perform well across cycles tend to align with basic human needs and institutional incentives, not with excitement. Ultimately, betting on these two assets is not about being clever, it's about being prepared. It's about choosing resilience over excitement and durability over drama. That choice may feel slow, but it compounds in ways that are easy to underestimate and hard to replicate. If there's one takeaway from all of this, it's that long-term wealth is built less by predicting the future and more by surviving it intact. The investors who remain after the storm are the ones who benefit most from the calm that follows. Preparation doesn't eliminate risk, it reshapes it. And when the next downturn arrives, whenever that may be, the question won't be who guessed the timing correctly. It will be who positioned themselves thoughtfully enough to endure, adapt, and continue forward. If this perspective helped you think more clearly about risk, safety, and long-term strategy, take a moment to like the video. Share your thoughts or questions in the comments, because different viewpoints sharpen understanding. And if you want more grounded discussions about money, behavior, and long-term decision-making, subscribe to the channel. Consistency beats urgency, and patience, when combined with the right principles, is still one of the most powerful tools available.